Okay, so section 4 of chapter 8 then, it starts off with the money market. So we're going to have a look at what the money markets, or what money market is. We're going to think about what the capital market is, and consider a few different sources of finance there. We'll also then move on to look at sources of equity finance and sources of debt finance. We'll see how far we get. Don't want to make the recording too long, otherwise you tend to drift off a little, I'm sure. Okay, so money markets. Money markets is essentially a place that we come together to buy and sell investments. If you want to think of that in terms of borrowing or lending money, that's absolutely fine. We've got this phrase here, marketable securities. So rather than investments, we use this term marketable securities, and we've got the definition of marketable securities underneath. Short-term, highly liquid investments that are readily convertible into cash. Okay, so we've got a few instruments here from the money market that we're just going to have a quick chat through, and I'll tell you a few of the characteristics of each. You could potentially be asked to discuss, to pick one of these from a choice, from a list. So they might describe a particular instrument to you, and then you might have to pick which one they have described. Okay, so treasury bills. Treasury bills are just are bills issued by the treasury. So they're issued by the treasury. So part of the government, and as you'd expect, because of that, they tend to be very low risk. But as we know, low risk is going to mean that we get a low return also. So nice and safe, but you're not going to make lots of money from that. Deposits, just thinking about the money that is sat in bank accounts. Okay, so money deposited in those bank accounts. Certificates of deposit are fixed term, fixed interest instruments. So you know exactly when the loan is going to mature or require to be repaid, and you know exactly what the interest rate is going to be over the term of the loan. Okay. A gilt is again a government issued debt, but this time it's a longer term. A bond here we're just going to refer by an instrument issued by a company. Okay, they tend to be usually secured, so they're usually secured on an asset. So if you don't repay, you lose the asset, and they tend to have a fixed redemption date or a fixed repayment date. Finally, then we've got a commercial paper, which is quite similar, but it's essentially an IOU, which again is issued by this time mainly a larger company. Now, you don't need to know bundles about each of these. Again, just to pick out the characteristics of each. You'll go on and learn more about each one when you progress through your studies, but for now, just being aware of the different types is absolutely fine. Okay, section 5 then moves on to the capital market. Now with the capital market, we tend to think of this, although it can be used for short term, we tend to think of it mainly for longer term. And over the page there, we've got a few examples of the different capital markets that a business can access. So obviously we've got national stock exchange. So in the UK, we have the main market, and we have the alternative investment market, the AIM of the London Stock Exchange. And this is obviously made up of two different markets. So we've got the primary market where we have new issues, and with the secondary market where those can be traded then. So if you float, if you go public, the initial issue of your shares will happen on the primary market, and then if anyone wants to buy or sell your shares after that, that will happen on the secondary market. Okay, the banking system also counts, is also included in the capital market, and like we said, we split that into retail for smaller transactions and wholesale for the larger. Bond markets, again, bond markets where you're going to pick up big amounts of money. Leasing, really important source of finance these days, so sometimes much easier to get a lease rather than a loan to buy something. Obviously the security is already built in. Debt factoring we will consider, but we'll talk about that in a bit more detail a little later on, so don't worry about that too much right now. And then finally, international markets. So international markets are generally for bigger companies, and it just allows you to borrow in different currencies if, for example, you need to invest overseas. And building on what we said earlier on in terms of equity and loan, long-term finance tends to be in the form of shares, which we'll have a look at a couple of types here now, or bonds. So when we're talking about shares, when you hear this term equity, generally we're referring to ordinary shares. So ordinary shares are the owners of the business. They get voting rights, and that means that they can have overall control. Preference shares are slightly different. Preference shares are normally given a fixed maximum dividend, and they're guaranteed that dividend before an ordinary shareholder. So slightly less risky than an ordinary shareholder, so therefore it's normally slightly less return. But because they're given this fixed dividend, that sounds a lot more like a loan. It sounds a lot more like an interest payment. So in many ways they are pretty similar to debt finance. Loan stocks or debentures or bonds are all generally the same thing in this context, at least. Typically fixed interest rate borrowings, and they have a set repayment date. Generally they're secured, so they're secured on a particular assets or secured on a floating charge over a group of assets, and that just means that you have a bit more protection. Okay. Section 6 then I'd like to get through in this recording, and then we can have a break before we move on to section 7, which is looking at sources of debt finance. But for now, let's start out with equity finance. So first source of equity finance, the most commonly used source of finance, most important source, is retained earnings. So all of those profits that you've built up over the years, over previous periods, you can then either pay out in the form of dividends, or you can reinvest that in your business. So really, really important. Okay, from there then we need to start talking about shares. So the first thing we're going to talk about is a rights issue. So a rights issue is a way of giving or selling new shares to existing shareholders. And we call it a rights issue because you obtain the rights to buy more shares. And those rights are always in proportion to their current holding. So let's pretend that we have 4 shareholders. And currently they all have 100 shares each, so they own 25% of the business each. If the business decided to raise more money for some sort of investment, let's say they're going to launch a new product or something like that, and they decided they are going to do a 1-for-4 rights issue, all that means is we are going to give the current shareholders the right to buy 1 new share for every 4 shares that they currently have. Now, let's pretend that every single one of those shareholders, all 4 of those shareholders, take up that offer. So, each one of them is going to buy 25 new shares. So for every 4 shares they currently have, they can buy 1 more. That leaves them all then, obviously, with 125 shares each. And the business has raised money by selling shares, and yet all of those shareholders have maintained their level of control. So they all still have 25% of the business. Because of that then, you have to legally make a rights issue before you issue new shares to the public, or a new issue to the public. And this means that all shareholders have the rights of first refusal on the new shares. So as long as they've got the money to buy them, they can then maintain their control. Often though, shareholders won't have the money or will choose not to, and they can waive those rights and they can sell them to others instead. So what does a business need to consider when making a rights issue? First of all, issue costs. They can be very substantial. In fact, they've been estimated at 4% if you raise £2 million. So that's an awful lot of money as an issue cost. What else do we need to consider? Shareholder reactions. The problem is, I mean, I kind of sold the rights issue as a good thing in the sense that you can maintain control, but really you're forcing your shareholders to buy more shares, and that's because they're unlikely to want to lose the amount of control that they currently have. So you're basically forcing them to do that. Control shouldn't be too affected as long as everyone takes up their rights, but if you don't have the money to take up your right, that means you're going to lose control. And that's a particular problem for unlisted companies. So unlisted companies tend to be the smaller companies. And you'll often find there that the existing shareholders do not have sufficient funds. Okay, don't have sufficient funds to take up their rights, and therefore they're going to lose control. Okay, so that's the first type of issue for selling shares. Next, we've got a few extras. So if they're new shares, we can either perform a placing, or we can do what we call an offer for sale, or we can do a direct offer. Now, a placing is where the company will sell the shares to what we'd call an issuing house. Okay, so something like an investment bank. The investment bank then will place or really sell the shares with its clients. Okay, so we can choose, or the issuing house can choose who actually gets those shares. Offers for sale and direct offers then are public offers. And they are slightly different in their approach, but still end up with the public buying your shares. With an offer for sale, again, we go via an issuing house. It gives us a bit of protection, and then they sell on to the public. Or a direct offer is where we just go straight from X PLC to the public. Okay, and obviously that's a bit more risky, so you tend to find that that's for kind of more well-known companies. 6.4 then looks at preference shares. So we mentioned preference shares. We said that they're pretty similar to debt finance, but they're really good because they're not actually debt, so it doesn't affect your gearing. Well, in fact, sorry, it doesn't increase your gearing, is probably a more accurate way to put it. And also it doesn't dilute your current ordinary shareholders' holdings. So it doesn't have the same rights as an ordinary share. So it doesn't affect your ordinary shareholders in that way. Drawbacks, as soon as you guarantee someone a dividend, that's it, that's guaranteed then. So it's not optional like a normal dividend. So you've got that kind of guaranteed outgoing. Finally, 6.5, we need to consider a big company going public for the first time. So floating on a stock exchange, and there's various listings that this can go through. So you can have a standard listing or a premium listing, that sort of thing. And the study manual is a good place to go and just kind of pick up those details. Not going to be lots and lots of questions, but just to give yourself a nice overview. What I'd like to move on to though is this interactive question. So think about a company who's currently not listed, listing for the first time onto the stock exchange. What advantages will that bring to the business? And then also we need to consider any disadvantages too. So as is the norm, what I want you to do is just pause the recording then, jot down a few ideas, and then we'll come back together and have a chat through before we finish off for this section. Okay, if you can pause it now then and have a think. Okay, hopefully you've got a couple of ideas there. Again, the solutions are at the back of the note, so once we've had a chat here, have a look just to make sure your answers are along those lines. Okay, let's think. Well, immediately the first thing that pops to mind in terms of an advantage is it opens up a massive amount of potential investors. So it gives you access to a much larger source of finance. Think of the amount of people that are willing to buy shares on the stock exchange. So immediately opens up lots of doors for you. Also, one that's not often thought about, or one that's not often immediately obvious, is that it increases the marketability of your shares. And what we mean by that is it makes them a lot easier to sell. And as soon as you make something easier to sell, it becomes more valuable. So the fact that I can buy a share from a PLC, and I know I can sell it immediately afterwards, will increase its value for me. Okay, it increases my flexibility. So hopefully that increases the share price. Drawbacks, then there's probably way more drawbacks, mainly down to the amount of regulation around the stock exchange. But certainly the cost of floating would be one of them. That can be pretty significant. And then, like I said, things around regulation. So it's not possible for everybody to float. For example, 25% of your shares have to be in the public hands already. And obviously you have things like your 3-year trading requirement and that sort of thing. So you need to be careful around those different types of regulation. Okay, that's the end of this recording then. When we meet next, then we'll pick up on section 7, which is looking at different sources of debt finance, and then we'll finish off the chapter in that recording too.